Hi, everybody. Good morning. I think in the interest of time, we will make a start. I can see that some people are still joining. So good morning to you all. Thank you for joining us this morning, and a big welcome to the K3 Hub. My name is Marie Wadeson, and I'm a managing director here at K3 Advisory Group, and I also lead the K3 Hub, which sits at the heart of our relationships with the professional advisory community. We've got a jam-packed session today, so rather than using this time to tell you a bit more about K3 as I would normally do, there should be a slide that will appear on the screen which covers this off. So moving on to a little bit of housekeeping today. So we are recording, and hopefully you saw that as you joined the session. That we'll be posting the recording onto the K3 Hub website next week. Um, we have already shared and will continue to share a PDF of the slides that we're going to cover off today. That's in the chat, and as I said, we'll probably share that a couple of times throughout the session. Q&A function is open, so please do feel free to ask questions as we go along. I'm going to be moderating the questions this morning for our speakers. We've got three different sets of speakers today, so I'm going to let the speakers cover off their session. I'll then host the Q&A for each speaker immediately after their session. So if we don't get to your questions, or if you get your questions in a bit late, what I'll do is I'll pass those on to the speaker, the relevant speaker, and they'll come back to you separately after the session. I know that we have already had quite a few sessions in, so if we don't get to your questions again, I will pass those on to the speakers, and they'll come back to you directly. So, as I've said, on to today's website. So we not website, webinar. Sorry, there are three sessions today, each of around about half hour. So we have an essential update on R&D tax credits, what's shaping the current insolvency market, and HMRC hot topics. So, first up, then, I am very pleased to be able to welcome Adam Bointon and Hugh Wragg from randd. So, Adam has been on with us before. Hugh's making his debut with us today. randd is part of the K3 Advisory Group and is an R&D tax credit specialist. Adam is the technical director who supports SMEs across the manufacturing and software sectors, and he also works closely with accountants. Hugh is an R&D Compliance Manager who leads a specialist team supporting businesses whose claims are scrutinised by HMRC. Adam and Hugh, welcome to the K3 Hub, and over to you.
Thanks, Marie.
Thanks, Marie.
Okay. So welcome, everybody. Obviously, many of you on the webinar might be aware of R&D tax credits, but many of you might not be. So we'll just do a brief overview of the incentive itself and what qualifies, etc., before we move on to some more details, which are probably a bit more valuable for today's session. So what is the incentive? What is R&D tax credit? So the UK R&D Research and Development, or R&D tax credit, is a government-backed incentive designed to encourage companies to invest in innovation. So it allows qualifying businesses to reduce their corporation tax liability and, in some cases, receive a cash payment based on eligible expenditure and eligible projects incurred in the period. And there is a requirement that involves resolving scientific or technological uncertainty. So overall, the objective of the policy is pretty straightforward. By reducing the after-tax cost of innovation, the UK government just aims to make the UK a more attractive environment for R&D investment, supports economic growth, competitiveness, and productivity across all sectors of the economy. And actually, for businesses, the relief is significant. So depending on the applicable scheme and the company's circumstances, the effective benefit now can represent between 15 and 27% of expenditure. So making it one of the sort of more valuable reliefs available to UK companies. It started in 2000 by HM Treasury, and it was initially aimed at the SME, small and medium-sized enterprises, but that was quickly extended to larger companies through the Research and Development Expenditure Credit, or RDEC. That started in 2002, and that's gone through various guises and changes before taking its current form, which we'll outline later. So HMRC have a set of guidelines of what qualifies for R&D, and these are informed by the Department of Science, Innovation and Technology, or DSIT. And those guidelines are available online, and they're basically sort of draw upon the internationally recognised OECD Frascati manual, which is the R&D manual that was set out many years ago. So R&D tax credits do not simply reward companies just for innovation. So it's quite an important key principle to understand. There has to be a resolution of genuine scientific or technological uncertainty, advancing knowledge or capability in a way that a so-called competent professional could not predict or readily resolve in advance. So the application of technology in and of itself does not qualify. It is resolving uncertainty in the creation of new technologies or extending capabilities of current technologies and or science. So who qualifies? So R&D tax credits are available to any UK company subject to corporation tax. There's no restriction per sector or industry, so it's a broad brush policy. Relief is available to any company that meets the qualifying criteria, whether it operates in technology directly, manufacturing, food or drink, retail, wholesale, life sciences, financial services, etc. So the UK company just has to be a UK corporation taxpayer, and it must have taken qualifying R&D activity during the relevant accounting period, and it must have incurred qualifying expenditure during that accounting period as well. So yes, so the most common sectors, technology, software, life sciences, pharmaceuticals, manufacturing, engineering, food and drink, financial services, construction, energy, and even professional sport. So how does it sort of work? So there is a sort of broad set of costs that are available to UK companies, and that are typically the staff costs, externally provided workers, so that's workers provided through agencies, subcontracted R&D, so external contractors, they need to be based in the UK now, consumables, so material spend, electricity, utilities as well, software, you can have clinical trials, and data licenses and or data sets that are required. So an important part of it is recognizing that there is a technological uncertainty. That was a systemic approach to overcoming that uncertainty, and it is in a qualifying field of science and technology. So it's important to recognize that non-qualifying fields such as the arts, social sciences, economics, commercial aspects, commercialization. So it's all to do with resolving relevant scientific and technological fields, and it's that R&D period only. So how to apply? Hugh, do you want to go through that one?
Yeah, I can do. Thanks, Adam. So in order to make the application, first of all, a company has to identify those qualifying projects. And as Adam identified, those projects have to seek to make a relevant advance in a field of science and technology by overcoming technological uncertainty. So in identifying qualifying projects, obviously those projects will incur qualifying expenditure against them, against those cost headings, those cost centers that Adam just ran through. So there has to be a systemic approach whereby companies identify these costs against these projects with a review of activity across the board within the accounting period. So all technical aspects, all operational aspects, and an approach has to be taken in order to identify those costs and assign them to those projects. So the company, through an advisor or through their accountant, will prepare a technical narrative which will describe the qualifying projects, the advance that was pursued, the uncertainty that was encountered, and the steps that were taken to resolve that. Qualifying expenditure is calculated according to each category, and we'll talk a little bit later about the changes in the scheme and how those have been kind of codified within one single form, the additional information form. So that additional information form captures that information that's portrayed within the technical report and collates the expenditure under those cost headings. So once the additional information form is filed through HMRC's online portal, that then allows the company to formally submit the claim by including the relevant R&D numbers within the company's tax return, the CT600. Alongside that CT600, the company should file the cost breakdowns, the expenditure breakdowns, and a full documented version of the R&D technical report. And then once all of those documents are filed with HMRC, HMRC typically processes claims within 28 days. Some claims under the RDEC scheme do take a little bit longer. But there's a little bit of a misconception in terms of how those claims are approved, in inverted commas. Again, we'll come on to that in a couple of slides' time. Generally, most claims are automatically approved, as R&D generally sits within self-assessment, but we'll come on to how HMRC does raise a compliance check on certain claims a little bit later on. So thank you. Moving on.
Okay, so how have R&D changed over recent years? There's been quite a dramatic change, certainly over the sort of past 5 years or so. And the number and composition of claims filed to HMRC has changed dramatically, with just over sort of 87,000 claims filed in 2020-21. And this has reduced down to just almost 47,000 claims in the 23-24 period. Having said that, the actual cost to the Treasury has not fallen as dramatically over that period, staying at around 7.5 billion over the past 3 years. And actually, from the R&D Comms Forum recently sat, that is projected to increase to over 8 billion for the 24-25 periods, but we'll see when the statistics come out later in the year. So what we've seen is a large reduction in the number and amount claimed by the smallest companies in certainly the SME market, but this has been more than offset by claims at the top end. This all stems from a shift in the compliance landscape, which happened in around 2022, when HMRC estimated that 24% of SME claims contained error or fraud, adding up to around 1.1 billion of tax relief in that 2020-21 period. So this instigated several changes, not just in the compliance framework set out by HMRC, but actually in the core tenets of the incentive itself, such as how claims are administered and filed to HMRC, but fundamentally the generosity of the scheme and the calculation of the relief itself. And ultimately, that has resulted in the creation of what we call the merged RDEC scheme in 2023 and implemented from 24 onwards, and the removal of the SME scheme, with claims effectively ending for SMEs and the SME scheme in March 2027, once the February 25 accounting periods have passed their 2-year deadline. So the overall effect on the total landscape of R&D tax credits has been a fundamental shift to a compliance-focused approach, with companies, accountants, and agents sort of upping their game, so to speak, to ensure claims are valid and accurate enough to be defensible in case of an HMRC compliance check. But HMRC do have to strike a fine balance between achieving the policy objective of creating and delivering a generous tax benefit to the UK's most innovative companies, encouraging and supporting their genuine R&D efforts, whilst ensuring fraud and error is kept to a minimum. And actually, we believe the incentive is in a much better place now as compared to 5 or so years ago. Hugh?
Yeah, so in terms of the rates and eligibility, as Adam said, the merged scheme has limited somewhat the availability of tax relief to SMEs. The rate at which relief was available has reduced from around 27% to 20%, but that's not shut the door on the SME scheme in its entirety. For any R&D intensive companies who incur more than 30% of their total relevant expenditure on R&D within an accounting period, are still able to claim under the SME scheme, or the so-termed ERIS scheme, which allows companies to surrender losses for a higher rate of cash injection. Other rules which have changed with the merged RDEC scheme, which is relevant to companies whose accounting periods start on or after the 1st of April 24. So there's been a massive change in how subcontracted costs are accounted for. So overseas subcontracted expenditure is now excluded from the scheme. The reasoning for that is the Treasury ensuring that all costs are domiciled within the UK, essentially. There is one caveat to that where it's not entirely possible to conduct that subcontracted R&D within the UK, where the specific conditions for that research and development activity cannot be replicated within the UK. So overseas subcontractors have been eliminated. But on the flip side, where subcontracted costs were previously barred from inclusion within the large company scheme, the former RDEC scheme, those UK-based subcontractor costs are now eligible for inclusion within the merged RDEC scheme. In terms of process, HMRC introduced last year the mandatory advance notification or claim notification form for new claimants. That also does apply to existing claimants with a very complicated set of rules which govern that particular element. So the claim notification form was introduced to ensure that new claimants notify HMRC of their wish to file an R&D claim, and that form has to be submitted within 6 months of the closure of the accounting period. Now, that doesn't change the time frame in which claimants can actually file the claim. Companies still have up to 1 year after their tax return amendment date, so 2 years after the closure of the accounting period, in order to file that claim. But that introduction of the claim notification form has forced companies to consider their R&D activity and their R&D expenditure much earlier. So what that has done is eliminated the last minute filing of new claims which have been prepared in a less than robust manner, shall we say. Further changes that have been made. So a couple of years ago, HMRC, as I mentioned on the previous slide, introduced the additional information form, which was intended to standardise the way in which the technical elements of the R&D projects are submitted to HMRC. So that form contains a summary of all the R&D projects, and that can be supplemented with further detail in the form of evidence and appendices, and further detail with the projects, including the projects. And also that form contains a summary of the R&D expenditure, the total figures, of course, which will factor or be included within tax computations and tax return. Finally, the R&D Communication Forum is a forum that Adam and I sit on to listen to HMRC and to engage with HMRC in the most recent changes. So that's a collaborative body in which questions can be raised of HMRC in terms of the processing of R&D claims at HMRC's end, any rule changes, any legislation changes that are being considered, any other guideline changes below the legislation itself, and also any policy signals as well. Within that forum, quite a lot of information was given recently in terms of the changing landscape of R&D compliance, which nicely segues us into our next slide. So compliance checks and R&D inquiries. As I mentioned on our first slide a couple of minutes ago, there's a common misconception that HMRC approve R&D claims, and that is categorically not the case. So initially, HMRC have publicised this information, by the way. R&D claims are not approved by a person. There is a technology-led checking mechanism which HMRC utilise in order to process claims. Fundamentally, as I mentioned, R&D claims within the CT600 form a part of self-assessment for corporation tax purposes. So what does that risk profiling look like? The primary factor which HMRC utilises the company's standard industry classification code, or SIC code, and that code essentially denotes the day-to-day activities within which the company operates. Now, HMRC use that broad brush approach to expunge a series of non-compliant sectors, either rightly or wrongly, and target those particular sectors for further investigation. So those sectors include retail and wholesale, the trades, so plumbers, electricians, scaffolders, etc. Education, social sciences. So generally non-compliant sectors, but that doesn't stop particular companies within those sectors from engaging with qualifying R&D. Other factors that may be included may be significant pay-as-you-earn or VAT liabilities, or any other risk factor red flags that may sit against the company or particular directors in terms of late filing of tax returns, late filing of accounts, etc., etc. Other factors included may be the agent or the advisor, or perhaps even the accountant, having a certain risk profile with HMRC as well. And enquiries are opened in an initially informal basis by the submission of HMRC, or the sending by HMRC of an opening letter, which will have the Taxes Management Act 1970 written all across it. That can be then supplemented if the claimant is non-compliant with those initial enquiries by a Schedule 36 information notice, which is a legally binding document which requires the company to submit information and/or documents in support of their claim. So how to approach that? The first thing that a company should do is engage a specialist advisor immediately. And the reason for that is because often I've found in the past couple of years that claimants often don't see their R&D through the same lens that HMRC wish to see it. And what do I mean by that? So companies often portray their R&D at the, as we would term it, the company level. They do not see their R&D through a lens whereby the advances that are being detailed and the technological uncertainty that is being resolved, that information has not been portrayed to HMRC at a field-wide level, at an industry level. And often companies trip themselves up by talking about all the great work that they've done and the commercial benefits and the advance in company knowledge. But ultimately, what HMRC need to see is where that advance and where that uncertainty is relevant to the field as a whole. So in dealing with a compliance check, companies often dig themselves a hole. And the best thing that that a company can do in that case would be to engage a specialist advisor immediately in order to define properly where the R&D lies. The advisor will then assist the company in gathering any further technical information and supporting evidence. Will undertake a thorough review of the costs that have been claimed for relief, identifying any qualifying, potentially further qualifying or any non-qualifying expenditure that's sat within the claim as filed. And then there's a kind of series of different approaches which can take place. Generally, enquiries are resolved through correspondence, through a short number of rounds of correspondence with HMRC, with the particular caseworker on that case. Companies also have the option to sit a customer meeting, as HMRC term it, with respect to the case, where on a fairly informal basis, you're able to discuss elements of both the projects and the costs that have been claimed for relief. That is something that HMRC have offered a little bit more widely in recent months, as the kind of more junior team that have been dealing with the bulk of R&D inquiries through campaigns and projects at individual and small business compliance. That has slowly been wrapped up, and all R&D compliance is now moving to a more senior team within wealthy mid-sized business compliance, whereby claimants are dealing with an inspector who will manage the case end to end, rather than the previously task-based approach in which cases were passed around within the more junior individual small business compliance team. So how can we help? We can help with specialist enquiry support and representation through both correspondence and those technical meetings. We'll undertake a thorough review of the claim as filed and identify strengths and weaknesses, and seek to resolve that with the company. And we'll take any direct HMRC communication on board and deal with the claim and the compliance check back to front. We also offer kind of fee protection support and appeals advice. We have as it says on the slides there, proven track record in dealing with these cases, both for our clients where they're asked further questions, but also clients who have not initially utilised our support, and we can come in and assist them with those compliance checks. So moving on to final slide, please.
So yeah, just for the audience today. So randd UK offer a sort of partnering service for, in particular, accountants. And that's designed to be a simple, collaborative and low risk sort of approach to allow accountants in particular to expand their service offering without overstretching internal resources and exposing any extra risk to compliance. So it's a pretty simple process. You make an introduction to your particular clients, and this could be when a relevant opportunity arises or a year end is approaching, etc. And if you just like us to simply assess their eligibility, we will give a fair and honest opinion, or we can give a health check of any previous claims if a company has submitted a claim with a different advisor or done it themselves, for example. You maintain full control of that relationship and will just operate as a strictly specialist partner. So we can take care of all that technical and compliance workload, gathering the project information, financial data, technical interviews, preparing the full R&D report, as well as doing the additional information form and making sure that everything is aligned with HMRC's processes so that it's just robust and audit ready and all the packaging and information is available to all partners and stakeholders. You remain the client's lead advisor, maintaining the firm's relationship, and you can then ensure that you offer a high value service without needing to develop in-house expertise, which obviously in today's landscape, it has moved significantly on from where it was a few years ago. So we're just aiming to act as an extension of your team, not as a competitor, and it provides you with confidence that your clients are receiving expert support and protecting your reputation within your industry. There's no obligation to retrain your team or take on additional resources as well. So we can come in and help at any point of the process, whether it's from the very, very beginning or post submission, whether it's an inquiry defense, for example. So we're more than happy to assist in claims that we've not prepared ourselves and submitted ourselves if a client finds themselves in an HMRC inquiry. So please feel free to reach out if that's the case.
Just one final point as well, that that offer of assistance and partnership with yourselves also extends to all elements of the R&D life cycle. Excuse me. So if your client requires any support in grant applications, obviously within R&D, which we've talked about quite extensively, but also off the back of that, any other elements of tax relief, creative industries tax relief, patent box tax relief, video game tax relief, we can assist with all of those elements as well, alongside the R&D, in amongst that R&D life cycle. So yeah, thank you very much. Thanks, Marie.
Thank you very much, Adam and Hugh. That was very thorough. We have had some questions coming for you, so I will read those out as they've come in. So the first question reads, what clients are the best fit for R&D?
Do you want to say that, Hugh, or do me?
Yeah, I can do that. So what clients are the best fit? So obviously any clients that believes fundamentally that they are engaging in R&D activity, typically these would sit within manufacturing, engineering, IT and software, any traditional sciences, so chemical science, biological science, medical and pharmaceuticals, but also sports science as well. But we're happy to take a review of any claimant, any potential claimant who feels that they are engaging in R&D activity, as I mentioned earlier on. Often claimants who sit outside of the traditional R&D landscape in terms of their sector may or may not be engaging in any R&D activity. So we'll happily take a review of any potential cases.
I think the most common example of that is probably retail and wholesale, where they have in-house engineers and expertise that provide a service, but principally the trade of the business is in wholesale, for example. So componentry, etc. But they offer an external facing site support service as well. So they have in-house expertise. So that's probably a very common example of that.
Thank you. So I guess the point you're making is it's sector based as opposed to the size or the turnover of the business itself. Is that right?
Yeah, I mean, it's open to companies of any size. if you look at the statistics, you would say the larger the companies and the most prevalent claimants. So only around 3% of SMEs claim R&D tax credit, so it's quite a small proportion, and that's employers only, so people without any employees, that's discarding that. But whereas at the top end, the very largest companies, 75% of those companies sort of claim R&D tax credits are 500 employees and above. So as you grow up, the likelihood of R&D is more common.
Right, okay, got it. Next question then in that case. So John's asked, what does your end-to-end process look like? And I assume that's end-to-end from sort of contacting you about a client to sort of going through the process.
Yeah, so in terms of that, yeah, so we obviously have an initial scoping call. We will speak to the owners of the business or the relevant decision makers within that, and then try and have a conversation with the relevant CPs or competent professionals, the engineers, etc., in that business to at first discern whether or not there is a potential for a claim to be made from that. Going on from that, then once everyone's happy and the letters of engagement have been agreed on those terms, then yeah, we will start to conduct technical interviews with the relevant people involved. That can take from 1 hour to 2 hours up to multi-site visits that take that cover several weeks, depending on the size and the complexity of that claim. Once that information is gathered, then we can then sort of absorb all the financial information from purchase ledgers and payroll data, and we can internally process and cleanse that, and then we work with the client to help apportion the relevant costs to the relevant projects on a project by project basis. So we can prepare all the technical reports and financial schedules during that, and we work quite collaboratively and open with that. So we ensure that the client themselves has full sign off on those schedules, has full sign off on the technical report to make sure that those marry up and that reflects the work that they have done. And then we'll either file it ourselves if it's an amendment, or we can hand everything to the accountant and do the AIF in advance of the corporation tax being filed. So we have an end-to-end sort of process on that look.
Great stuff, thank you. I do have one more question for you, but I'm conscious of the time. So what I'll do is I'll send that to you after this session and you can go back directly. So in that case, I'm going to move on to our next speaker. So I'm very pleased to be able to welcome Alex Roberts from Quantuma. So Alex is a director who specializes in insolvency and restructuring engagements. He advises directors, creditors, and stakeholders on corporate distress situations and overseas restructuring. He's led some high-profile assignments recently, including complex FCA-regulated matters. Alex is making his debut on the K3 Hub today, and welcome, Alex. Over to you.
Thanks, Marie. Morning, everyone. Thanks for having me on today. I appreciate that insolvency stats at this time in the morning probably isn't everyone's idea of a good time. So I'll keep this as relevant as I can for everybody. But what I'll aim to do is over the next few slides is look at what's really happening in the market. We'll start with some insolvency stats, as I said, move on to what we're actually seeing as insolvency professionals and whether tools like CVAs are becoming more relevant. A brief look at the economic backdrop and then what's really driving director behaviour, and ultimately why timing is sometimes the key factor in all of this. So looking at the next slide and formal insolvency stats, we can see that back in early 2021, numbers were artificially low, and that was obviously suppressed by massive government support packages. But as those interventions fell away, we can see that insolvency has steadily increased throughout 2022, and it actually hit a 30-year high in 2023 and early 2024. And whilst insolvencies are now falling, what we're looking at is the impact of the war in the Middle East and some kind of cost pressures that are yet to feed through. And what we know and what we can see is that HMRC have taken a stronger stance on enforcement since the pandemic, and HMRC often issue far more petitions than all of the creditors combined. Now, moving on to more recent times in 2025 and 2024, we can see that total corporate insolvencies at around 24,000, with CVLs making up the vast majority of these. Now, we've moved on from the post-COVID era, and what we see is that insolvency is now being driven by tight margins, stubborn refinancing issues, and generally higher rates of interest, and rising national minimum wage costs. In 2026, you can see the green line at the bottom, we saw a little bit of a spike in administrations, and this is a bit of an anomaly. We actually know that that's due to two large groups of companies entering administration, one with 100 connected companies and one with 73. So numbers are broadly consistent with where we've seen them over the last few years. Now, this brings me on to whether the CVA is making a bit of a comeback. So if you look at the numbers and the volume, CVAs are a little bit of an afterthought. The Insolvency Service logged around 186 CVAs in the entirety of 2025. And what we can see is that in early 2026, figures are broadly similar. But what we can see is that they remain a small proportion of insolvency events, but they actually are or have the potential to position themselves for a little bit of a strategic comeback. And this is precisely happening because the alternative option in a Part 26A restructuring plan has just become a little bit unworkable for the average corporate clients. When restructuring plans were introduced in June 2020, they were hailed as a little bit of a game changer, and they offered a major advantage in the ability to cross-class cram down creditors and put dissenting creditors into line. But what we've seen over the last 5 or 6 years is that in the courts, restructuring plans are becoming more and more litigious and incredibly complex and overall quite expensive. Now, from a mid-market or an SME company point of view, executing a successful restructuring plan, it requires almost an impossible standard of due diligence. The courts demand massive valuation evidence, extensive expert reports, and quite meticulous financial modelling, and that's all to prove that the creditors won't be worse off in an alternative scenario. And SMEs and small companies just aren't able to keep up with that level of due diligence. They often lack the administrative infrastructure, the lack of the deep financial reserves to absorb weeks of court litigation, and often can't afford to keep up with the professional fees when HMRC and other creditors do fight back, which we're seeing a lot more of. So look, CVAs aren't kind of going to hit big numbers anytime soon, but what we can see is that they are regaining some of that critical importance, and we're starting to see early signs of that. So moving on to the next slide, generally what the backdrop that directors are operating in is, I'm not going to tell anybody things that you probably don't already know, you haven't read in the papers or seen in reports, or indeed heard from your own clients. The current economic climate we're operating it's been well documented, it's low growth, and we see persistent cost pressures, and what underpins all of this is just a constant sense of uncertainty in both consumers and businesses alike. So what does this mean for directors? Well, we see tighter credit conditions. Over the last few years, lenders have moved from a position of generally quite supportive and accommodation into risk management and generally being more selective. During COVID, cash was abundant, facilities were extended, and covenant breaches were often waived, and government-backed lending filled much of the required gap. What we're seeing now from lenders is that they are lending with requiring stronger security or covenants, and I see this in a lot of the pre-lend work that we do. In some cases, they're just actively reducing their exposure, and overall just a general less of an appetite to lend. And where a business might have previously extended its overdraft or refinanced with a current or even a new provider, or secured additional working capital from elsewhere, those options just aren't available to the same degree. Now, in terms of interest rates, we're seeing that they're obviously higher for longer. And just like personal finances and home mortgage rates, the commercial lending market has seen significant changes over the last couple of years. Base rates are materially higher, we all know that, and refinancing costs are 2-3 times of what they were at recent levels. And so for directors, this ultimately means debt that was once manageable just becomes structurally unaffordable. Now, we've touched on this, and we could see this in some of the figures earlier in the graph, is HMRC are having a little bit of a resurgence in terms of enforcement. They're taking a much firmer stance on arrears. They're accelerating in enforcement action and just reverting to issue winding up petitions as the main tool of enforcement. We know that from the numbers, we know that from the figures that we see. In Q3 of 2024, HMRC issued 630 petitions. Contrast that with Q1 of 2025, and it was over 1,000. And that there's no seasonality in that. We see that in the numbers into 2026 as well. Now, looking at consumer confidence, generally it's quite flat. There's weak sentiment across the board, and consumers are spending cautiously. They're deferring larger purchases, and that flows directly into retail and hospitality and the construction sector. And we see that play out in the insolvency stats mentioned earlier, with those industries making up the bulk of those numbers. Now, looking at business confidence, we see that the data shows us it's very much of a head down mentality and waiting and hoping for better times. According to recent reports, 57% of small business owners expect a recession in the wider economy. Even this week, the data released from the ONS, we see that payroll numbers have dropped, vacancies continue to fall, and this is a clear indication that businesses are acting on that cautious feeling and scaling back the recruitment activity. What we see even more is that economic resilience for business still correlates heavily with location. Somewhere like the Northwest having significantly higher insolvency rates than, say, London. Somewhere like the Northeast having higher insolvency rates than, say, London or even the Northwest. Now, you often hear about the UK economy talked about as one thing, but in practice, it's a little bit more nuanced and fragmented. Directors in various locations are operating in very different economies. London, the Southeast, we have stronger access to capital, more diverse sectors and lower insolvency rates historically. Contrast that with the North and the Midlands and Wales, we see regional economies based on higher exposure to manufacturing, construction and generally lower margin sectors. And this again typically results in higher insolvency rates and distress. It's also worth noting that it isn't just a north-south divide, and this tends to be one of regionality, as I said, and we've got some clear examples of regional outperformance. Manchester, my home city, is often cited as being the outlier. Equally, cities like Leeds and Birmingham and to some degree Liverpool and Newcastle, they've all seen strong growth areas in professional services, tech, and just generally attracting that investment. Now, I mentioned Manchester as a bit of a clear regional outlier. I won't say that too loud next to Andy Burnham. I think he'll take quite a lot of credit for that over the coming weeks and months. So moving on to the next slide. We've talked about what backdrop directors are operating in, and now we need to look at what are the main areas that are effectively trying to keep them awake at night and what they're worrying about. Now, we know that directors aren't sitting there worrying about GDP. What they're worried about is a little bit more nuanced. It's much more immediate and practical. It's simply cash coming in and bills going out and whether the business can keep trading for the next few months. What we're seeing more and more is that pressure isn't coming from one single issue. And we can see here that there's normally a lot of factors that sometimes are all hitting at once. We look at cash flow, we look at liquidity, and we look at the debt burden and issues with access to funding. And one of the biggest changes over the last couple of years is just simply how businesses are funding themselves and accessing that. We're seeing a significant increase in SMEs relying on multiple short-term funding solutions. Now, this is often quick access facilities with a high cost and ultimately personal guarantees. One of the things we're seeing more and more in practice is, and I suspect quite a few people are seeing this as well, is that it's effectively the SME equivalent of payday lending. Now, it's not labelled in that way, but economically, that's essentially what it is. It's minimal underwriting, it's personal guarantees, it's putting your home up for security, and ultimately the high costs that come along with that. And often we see that multiple facilities are being layered or stacked, with directors telling us they're getting 3 and 4 and sometimes possibly more of those facilities with each lender. And we know that borrowers, they often borrow in smaller amounts for SMEs, so 25, £100,000 and the figures in between. And we know that SMEs rely on this short-term flexible finance rather than something structural or more formal. Now, each facility looks fine in isolation until we start to add them together. And we know that interest rates are still elevated, and we know that ultimately leads to higher debt servicing pressure. Now, interestingly, we also know that around 80% of SME loans and lending facilities, overdrafts, are at floating rates, and that exposes them to things that we've seen in the past with higher interest rates. And we know that high cost of credit is cited as often the main reason for underinvestment. Now, in practice, what all of this means for directors is cash flow gets squeezed, debt repayments become fixed, and there's little room for shock events when they do happen. Now, looking at rising costs, we see another major pressure point, and one that comes through consistently is wages and the associated costs of all of this. And whilst inflation has come down from its peak, it doesn't mean that things are getting any cheaper. It doesn't mean that these things have gone away. Now, in recent studies, around 36% of UK businesses reported staffing costs increasing in a recent 3-month period. And that's not a shock for any of us. What is becoming quite apparent is that over 80% of directors in some recent surveys have said that the single biggest driver of what they believe will be the biggest costs is employee costs, it's wages and all of those associated pension liabilities, etc. Now, we know that businesses can't easily reduce wages. They can't avoid statutory increases. And unlike other costs which possibly can be mitigated, labour isn't flexible. It's largely fixed. And this creates a constant balancing act for directors between protecting margins or maintaining staff and keeping the business competitive. And we know that rising costs directly contribute to cash flow pressure, reduced headroom, and the cycle continues with increased reliance on external funding. And these are all core drivers of insolvency trends identified earlier. And when you combine rising costs with higher interest rates and short-term funding, we know that leads to creditor pressure. Now, in terms of creditor pressure, and I mentioned earlier, for a number of years post-COVID, HMRC was relatively supportive. Time to pay arrangements were in abundance, and enforcement was generally slower. And tax debt remains extremely high across corporate entities. The arrears start to build, the warning letters arrive, or there might be a failed time to pay. And that's obviously sometimes ignored or not acted on as quickly as possible. And then a petition might be issued. And then within days, this becomes quite critical. And we all know that once a petition is advertised and it goes public, the bank account freezes the bank account. Credit facilities are withdrawn and suppliers tighten or stop trading in their entirety. And what we see in practice, as I'm sure this is not familiar to anybody in the room, is that directors don't tend to ignore HMRC, but they often end up prioritising around it. We see that HMRC frequently becomes the creditor that gets pushed back to the end of the queue, partly because historically it's been perceived as slower to act. Now, the last one on this slide is cybersecurity. And up until now, everything that I've talked about is financial or cash flow or kind of debt-based. And this isn't the one that directors often lead with, but it is something that's becoming more of an issue. 43% of UK businesses experienced a cyber breach or attack in the last 12 months. And that might be something to a big cyber attack or a small little breach. But what we know is that SMEs make up the vast majority of those victims because they're often underprepared for these types of issues. An average cost of a small breach might be anywhere of £3,000 to £8,000, and obviously much higher in severe cases. And we know, and we've seen over the last 12 months of some pretty high profile issues that have happened. What we also see is that even the smallest cyber event leads to immediate trading disruption, which leads to cash flow issues. They might come with unexpected costs, and 30% of affected SMEs report reduced business performance even after the attack and the issues have been fixed. For a business that might already be distressed or on the verge of becoming distressed, a cyber incident can be a real issue. Now, on to the next slide. Some of these warning signs that are often rationalised by directors. It's not about the fact that they ignore them, it's about the fact that they start to justify these issues. They tend to rationalise them and make them smaller than they actually are. Now, many directors have seen difficult periods in the past, and often traded through them, and they might see some of these issues as a little bit of a dip. Most of these issues don't appear overnight. They creep in quite gradually, which makes them easier to justify. The priority is almost always keeping the business going, and decisions tend to be made in the short term rather than in the longer term. Now, individually, we know that all of these things on this page are in most instances explainable or in isolation and often manageable. The issue is when they start to combine, or you start to see a couple of these things happening at the same time. So just picking out a couple of those things that are on the slide, one of the biggest and most important issues is that we see is that lack of visibility on management accounts, or just generally on generally accounting systems. We see that management accounts are delayed, they're often incomplete, or they're not regularly reviewed. We see cash flow forecasts, even if they are prepared, they're missing completely. Sorry, they might be missing completely, and even if they are prepared, they're outdated, or they're not reflecting the real-time position. And that's largely because a lot of directors are too busy to focus on the numbers. They rely on instinct. We know their business, that we know the seasonality, we know the pinch points. And this is ultimately where accountants play a really important part, because obviously you guys will see the first issues of these and start to see them emerge. Now, looking at the next one, we see cash flow. And this is something that we as insolvency professionals constantly see directors trying to rationalise. Most directors obviously won't come to their accountant or come to us and say, we've got a cash flow problem. They'll describe it as a timing issue, a debtor that's not paid, a large supplier payment that's had to go out, or a temporary issue just before things improve. And it looks like paying the most aggressive creditor first, rotating the suppliers. We paid them last week, so we'll hold off for them until next week, holding back one creditor to meet another. And in reality, cash flow distress doesn't look like a crisis event on its own. It's evidenced by a series of behaviours. It's the juggling of payments, the creeping reliance on HMRC, and the general creditor stretch. And because the business is still trading and still functioning, it doesn't always feel like it's a failure. It feels like a normal trading scenario. So looking at the next slide, in terms of what directors want from their advisors right now, is we see that directors want clear commercial advice. They want proactive advice. And what we're seeing is that expectations have shifted quite significantly. Directors of SME companies have always wanted something more practical, and recent studies have found that they want their advisors to bridge the gap between them and their own knowledge. As I've mentioned earlier, corporate clients are facing challenges and cost pressures, and they're changing how they view their external law firms or accountants. And increasingly, they want advisors who are able to use technology and data to truly understand their own business. More than anything, they expect a joined up approach and advices that bridges gaps between finance and legal areas. Historically, a director would have gone to the lawyer for the contracts and the accountants for the numbers and the lender for capital. And the problem is we know that these things rarely happen in a vacuum. So just moving on to the next slide, please, is ultimately why timing matters more than ever. And this is probably one of the most items for today. We know that what ultimately drives a good outcome is being able to deal with these issues and these challenges as quickly and as early as possible. From my own experience in providing genuine restructuring advice rather than the implementation of an insolvency process, we tend to approach this in three distinct stages. So we have an early stage, which is where we can be the most proactive, where we would attempt to address underlying problems via an independent business review or operational changes such as redundancies. It might be as simple as implementing cash flow forecasting or strengthening an existing finance function. The next stage that we see is very much one of stabilisation. In this stage where pressure starts to build, the focus shifts from addressing the problem to attempting to stabilise the business. And that might be through a time to pay with HMRC or some other kind of creditor negotiation. It might be cash monitoring for a bank. And we might look at bringing in external advisors such as FDs, but with specific turnaround experience. Now, unfortunately, the late stage, and this is where directors and advisors are more reactive, and we try and protect what's left of the business, is that we're much more it's much more out of control for directors, with options being driven by directors driven by creditors rather than the directors themselves. Our response might typically still include some of the earlier bits that I've mentioned, but ultimately you're looking at formal insolvency processes or an accelerated sale of the business or part of its assets. And ultimately that's why timing matters more than anything, because the earlier you act, the more you can control, and ultimately you can control the outcome. And we see it time and time again. It's often a better outcome the earlier we can act. So hopefully that's given a bit of a practical view of what's actually happening, how directors are responding to challenges, and the challenges they're facing and the pressures they're under. Like I've said before, much of that won't be new to anybody on this call, but hopefully the one takeaway is that the earlier signs we see in the numbers and the things we often see first as advisors, they really do matter. So I'll pause there. I'm happy to take any questions, and thank you.
Thank you very much, Alex. That was really interesting, and for somebody who's made his debut today, whatever you said there has struck a real chord with our audience. I've got lots of questions for you, and I'm also mindful of time, so I'm going to get through as many as I can do. So again, I'll just read them as they've come in. So, given your comments on CVAs, where do you think they genuinely still have a role compared to restructuring plans or informal solutions?
I mean, ultimately, they're far cheaper and less complex. And so just by those 2 points alone, they endear themselves to the smaller companies. They're still highly effective for companies that have multi-sites, retail, leisure businesses, and they need to shed some of those expensive leases, or just leases that aren't working for them. They're ideal for keeping the existing corporate entity alive. They can preserve value. So ultimately, they hopefully will come the preserve of the smaller businesses, because they're just able to be a little bit more cost effective.
Great, thank you. So the next question. Right. So are HMRC still agreeing time to pay arrangements, or are they much stricter now?
We've certainly seen an uptick in people coming to us to look at time to pay arrangements. They're still agreeing them. I think they're agreeing them in bigger numbers. HMRC have heavily invested in departments of staff solely dealing with time to pay arrangements. We are, as I said, seeing an upward tick in them. I think in March 2024, there was 11,000 more in that period that were agreed in the prior year. Around 14% of all HMRC debt is currently in a time to pay. So where we're seeing is that the HMRC might be offering more of them. What we're seeing is that they're being less flexible with them. Shorter arrangements, and generally less patience from HMRC, much closer monitoring, far less tolerance for missed payments or repeat arrears. So they're definitely offering more of them. It's just that they're being stricter with them and implementing and taking tighter control of them.
Brilliant, thank you. And I think one final question for you then in that case. So the question reads, for those of us advising clients, what's the one thing we should be doing differently when we spot early distress?
I think being quite forceful so if you're an accountant, so it's being quite forceful with clients to implement rolling 13-week cash flow, for example. It's having that transparent dialogue with HMRC and just being proactive with those conversations. It's maybe from a lawyer point of view about reminding boards of their legal duties, and how the shift changes from one of a duty to shareholders to a duty to creditors. It's just about having those early conversations, and just being more proactive with the advice that we give clients.
Perfect. Thank you very much for coming on today. I'm going to call it a day there, but I do have some questions that I'll package up and send on to you after today's session. You can go back to the people who've asked them directly. So moving on to our final session for today. So I'd like to be able to introduce you to Jeremy Johnson. Jeremy is a regular here on the K3 Hub. He's a managing director at inTAX, a specialised tax investigations firm and one of the core brands under the K3 Advisory Group. He advises clients on a range of matters, including running fraud inquiries, disclosure of errors, and conducting appeals and tribunal work. He understands the workings of HMRC inside out, having worked there. Jeremy, welcome back, and over to you.
Good morning, Maury. Thank you very much. Thank you. Good morning, everybody. Going to rattle through a few areas today, just a bit of consideration about what HMRC is up to and what it's focusing on at the moment, and a few specific areas of focus, some of which have actually been around for a little while, but things that HMRC continues to or is starting to look at in a bit more detail. And also just touch on at the end a little bit around some of HMRC's statutory powers and some of the safeguards, and some of the things that we're seeing from HMRC in terms of how it's approaching various aspects. So if you can click onto the next slide, in fact, probably slide 3, the one afterwards. So the first thing I want to pick up on is in relation to HMRC's focus and increasing the amount of work that it's doing in certain areas. Just as a reminder, HMRC uses a system called Connect. It's used Connect for a long time, it's a system which HMRC uses to locate cases or identify potential cases for inquiry. Connect gets a lot of information from lots of different sources. It always has, and those sources are just increasing. So Connect will have, for example, if you're an individual, Connect will have self-assessment data. It will have access to Experian data, bank interest, land registry, yacht registries, plane registries, various sources of data. And that is all kind of profiled, and your tax return might be looked at in the context of, well, what data does HMRC have about you and how you live your life and what income you have, etc. So Connect has been around a long time. HMRC has been getting better at using Connect. And also, from what I've seen in the press, HMRC has just signed a contract with a UK AI company, which will allow it to better profile the data, I assume. But as mentioned, in terms of the availability of information, HMRC is getting more and more. For example, common reporting standards information from abroad. If you've got a bank account abroad, and HMRC is obviously sharing data outwards as well. But as a matter of course, and there have been various stories about new kind of online sales tax. There are no new online sales taxes, but what HMRC is getting more of recently is data from various online sales platforms, crypto platforms as well. So, for example, for quite a while now, in fact, I would say we've seen cases, let's say, in the restaurant industry, where HMRC has got data from somewhere like Just Eat. It's compared that Just Eat data to, let's say, VAT returns. And if the Just Eat data on purely one takeaway platform looked close to the turnover, HMRC is going to open inquiries. So HMRC is getting more and more of that data. And we're also seeing, for example, if you have a business selling on eBay and Amazon, HMRC seems to be profiling that data a little bit more in real time in terms of what it's getting from Amazon, comparing it to VAT returns, and opening inquiries if there are mismatches. So more and more data coming in, and HMRC is getting better and better at using that data to identify cases. Sometimes it's mistaken, and as always will be, but it's getting better. HMRC is continuing to use nudge letters and looking for voluntary disclosure. HMRC's found that nudge letters are a, a pretty effective tool for getting people to come forwards. Usually it's data based, so it could be let property, it could be worldwide disclosure, information's come from abroad, but it continues to be a productive and pretty low effort avenue for HMRC. They send a nudge letter, and really the onus is then on the individual to do the work and make the disclosure rather than HMRC having to spend several years going through an inquiry. And the final thing that HMRC is doing thematically, that there seems to be a continued and increasing focus on personal liability. Quite a lot of cases where companies, for example, end up going into an insolvency process. HMRC is the largest creditor, and HMRC has been doing a lot, and we'll touch on one of the tools that it has to make individuals personally liable for any HMRC debts rather than leaving behind in a company. So if you can flick onto the next one, please, the resourcing and strategy. So in terms of where resources is going, HMRC staffing levels have been pretty constant for some time now, but HMRC is looking to increase resource within fraud investigation service. Some more experienced investigators into FIS. There is a rising emphasis on criminal prosecutions. Just in terms of numbers, I think last year, 24-25, there were 300 prosecutions. A few years prior to that, there was only about 150 prosecutions. Pre-COVID, typically the numbers were around 500, 600, 700 prosecutions. So from the kind of 600, 700 a year prosecution level, COVID years, it dropped down significantly to probably less than a quarter of that. It's back up to 300 in the last year. The target is for 600 per year by the end of 2029. So there's clearly a focus on criminal prosecutions. There's also a focus on small and medium-sized businesses. Small and medium-sized businesses have been not entirely left alone, but we have not seen the same types of inquiries in the same volume that we would have had, say, 6 or 7 years ago in relation to small, medium businesses, whether that's COP9 inquiries or whether that's just normal inquiries, but where there are possibly problems around personal expenses being paid for by the company, money not perfectly accounted for, things like that. We've seen that diminish recently, and it's been identified specifically that small and medium-sized businesses are an area of pretty significant tax gaps. So we can expect HMRC to be looking at them harder. One of the downsides about movements and HMRC losing some of their more experienced staff through retirement is occasionally you do get a bit of inconsistent experience across different HMRC teams. So moving on to some specific areas of HMRC focus, I'm going to touch on 4 areas here: crypto, property, joint liability notices, and offshore. The first one on the next slide is cryptocurrency, and what's HMRC doing in this regard. And I think I'll split my comments into 2 areas in relation to crypto. One is what I would consider to be normal crypto, where people are buying a coin or a token and hoping it goes up in value and selling it. And then also some comments on increasingly novel situations. So firstly, in terms of more normal crypto events, as I've mentioned at the beginning, HMRC are getting data now from crypto trading platforms. For a long time, I think people believed that they were operating anonymously, even though everything on the blockchain is public. What is not public is necessarily your personal link with whatever happens to be in a wallet or whatever transactions have happened. HMRC is now getting data from crypto trading platforms. So potentially, as soon as you use a platform, even if you've had off-platform transactions previously, potentially you can be linked publicly to everything that you've done. I think the reality for most people is that they've probably made losses on crypto transactions, but there will be some people who've made significant gains. Um, I think the world of crypto, there's still a fair amount of misunderstanding in terms of what people's responsibilities are. There's probably a proportion of people who believe that they're just going to remain anonymous, and at some point in time they'll move to Dubai and cash out. But HMRC is getting more data. I think HMRC is playing catch up to a certain extent with the speed of technology, but HMRC is getting more data. And what we're seeing is that the point at which the crypto transactions then touch the real world again, for example, being deposited in a bank account, that can trigger SARS reports, which in turn can trigger HMRC inquiries. So it is important if you have clients or if you're an individual who is trading in crypto to keep good records. We've seen cases where there have been hundreds and hundreds of transactions, and trying to pin down what the value of each of those transactions at any point in time can be quite challenging. So keeping good records is really important. And obviously, people understanding the points at which they may have a chargeable gain. So disposals, buying an asset, changing from one coin to another. Just in terms of more complex situations, we are involved in a couple of larger and more novel cases, and the technology is moving so quickly that people are doing extraordinary and new things. And in that world, I think there are significant questions and significant difficulties in terms of trying to translate the activity that somebody is undertaking into the world of tax. You know, what has happened? What is it? Who owns that? Who's entitled to the money? Who's made a profit? What type of profit is it? Um, there can be some really difficult and really interesting questions. So, if you do have clients who are looking to move into kind of novel and complex areas of crypto, start their own projects, whatever it might be, some kind of asset-backed token. From what we've seen in relation to some big projects, it's always worth people getting advice, and probably legal advice in some instances, in terms of what is this, what are they entitled to, and everybody that's part of that project, what does it mean for them? So moving on to property on the next slide. Property, you know, the Let Property campaign has been around for years. I've probably spoken about it a number of times. It kind of begs the question, why is property still an area of focus? Um, I think lots of people get property income wrong. Lots of people end up being a landlord accidentally, as opposed to being a kind of a pre-planned and conscious decision. You might have a house and then you meet somebody, you move in with somebody, you decide not to sell your house and you rent it out. So there wasn't any kind of plan to become a landlord. People just end up being landlords, which is why I think we see quite a lot of mistakes in relation to property income. One of the biggest mistakes that we see in relation to property income is people's concept of whether or not they're making a profit, and whether or not their mortgage is deductible. We've probably in the last year done more let property disclosures than we ever have done before. And probably across 50% of those cases, the first comment that people make to us when we're trying to understand what's happened is they believe that the entire mortgage cost is deductible. So from their perspective, they haven't really made a profit. And as anybody who's an accountant is sat in the audience knows, obviously the whole mortgage is not deductible, and even not even all of the interest now is deductible. So people are making a tax profit where they wouldn't consider that they've made a profit. HMRC is still looking at property income. They still send nudge letters. increasingly, again, the theme is data. So not only is HMRC getting land registry data to identify cases, they're also scraping from websites where properties are being advertised for rent, getting data from the various tenant deposit schemes, and various bits of data from various places, which means that cases continue to pop up. Moving on to joint liability notices, and this comes in the context of HMRC pushing to make individuals responsible for corporate debts. Something that Alex touched on previously in his piece before mine, in relation to HMRC getting more assertive, but also HMRC sometimes being the biggest creditor. Joint liability notices are used to pierce the corporate veil in a number of instances, all of which must have involved some kind of historic insolvency event for a corporate. The three basic circumstances in which HMRC can issue joint liability notices are if there's fraud, if there's some kind of avoidance, or if there's repeated insolvency. And if the criteria are met, HMRC can issue a joint liability notice to the director of a current company where you've had previous companies go into an insolvency event. And the notice will make the director responsible for the HMRC liabilities of the insolvent companies and also any future liabilities of the company that they're currently working for. We've seen HMRC issue quite a few of these. Sometimes HMRC has been incorrect in terms of how it's worked out its maths as to whether it can issue these. There are various criteria that have to be met. But we're seeing these being increasingly used, as well as things like notices of requirement for security, increasingly used for as a tool for collecting debt. We don't think it's appropriate as a tool for collecting debt. Personal liability notices in relation to penalties, so moving again liabilities from corporate to directors. So from an HMRC perspective, the concept of the corporate veil is getting thinner and thinner. And there are lots of ways that HMRC are trying to make individuals personally responsible for their for the debts of a company that they're involved in. The last area of focus is in terms of offshore income on the next slide. Thank you. Offshore income and assets. In the last year, as I said, we've probably had more let property disclosures than we've ever had previously. And we've also had, apart from back in the day when the Liechtenstein disclosure facility was still running, we've also had more worldwide disclosures that we've helped with in the last year than we have previously. Why is this? Well, once again, I think HMRC is getting more data, but not only is it getting more data, HMRC is getting better at understanding that data and making judgments as to whether there's a problem or there isn't a problem. And once again, it begs the question as to, why are people getting things wrong? One of the common things that we see, whether it is an individual who's come from outside the UK to live in the UK and they've got some kind of asset, maybe a rental property abroad, or they've got some savings or investments abroad, or whether it's somebody that's always been UK resident, but they have purchased an offshore property, which they might rent out. Quite often the area of confusion is that they might be paying taxes locally wherever they have that property or that investment, but they don't realise that they most likely have a reporting obligation here in the UK, albeit if they are paying tax abroad, they'll probably get a credit against any UK tax that's liable. But that's a pretty common misconception, is that the tax is only where the asset is rather than being here in the UK also. The other point to note on offshore matters is there are some extended time limits even for fairly benign behaviours. So HMRC can go back further than it could if this was just a UK tax problem. Moving on to the last aspect of the presentation, powers, HMRC's main statutory powers, and if you jump onto the next slide. So a little reminder of some of HMRC's statutory powers and some of the safeguards and some of the things that we're finding a little bit challenging at the moment. So HMRC does have statutory powers to open inquiries, conduct inspections, it can raise assessments, etc. There are also a range of safeguards in place. So most HMRC decisions are appealable. One thing we'd always say is be mindful of time limits on appealing. Quite often HMRC is offering reviews, particularly in indirect taxes. It will conclude its inquiry and offer a review. Strict time limits in terms of when you should accept reviews. The review process, again, is one of the safeguards that's available. Occasionally, we're actually quite surprised that the review process throws up exactly the answer that we think should be the answer. So quite often it's worth going through the review process, even if there's a perception that it's not independent. There's also safeguards around information notices and what HMRC can ask for on a formal basis. But one thing that we've seen recently is, and this probably goes hand in hand with the concept of making people personally liable, but behaviours and time limits are increasingly been in focus from HMRC, and it's an increase. It's an area of challenge that's going up. It's an area of challenge that a very significant number of our cases involve. And when I say behaviours, what I'm talking about is the distinction between reasonable care, careless, and deliberate. All of those things have consequences in terms of how far back HMRC can assess, and also what level of penalty there is. So, for example, not that long ago, or maybe a decade ago, it would be pretty unusual for HMRC to seek a deliberate penalty if somebody had got involved in a tax avoidance scheme of some description. Not impossible, but moderately rare for HMRC to be making accusations of deliberate behaviour or even careless behaviour where HMRC where a client has got involved in some kind of tax avoidance scheme. Increasingly, HMRC is arguing careless, if not deliberate, in relation to that. The standard to which HMRC is seeking to hold taxpayers in terms of what they should have known, whether they should have checked, the degree to which individuals are checking. There is clearly an internal policy change in relation to, in the past, HMRC might have assumed reasonable care in most cases, whereas now it feels like HMRC is challenging itself to say, well, why isn't this deliberate? And starting from that point of view, and we're increasingly having to argue in relation to things not being deliberate or even not being careless. Moving on to the last slide, I'm conscious of time and giving a bit of time to answer questions. So in relation to information notices, a couple of things to say here. HMRC does have formal information powers. Most of the time in an inquiry, HMRC will ask informally for information, and most of the time in an inquiry, information is provided informally to HMRC. HMRC doesn't have to use its information powers. HMRC can use information powers if there is a lack of cooperation. Now, the information powers do also have safeguards. Information's got to be reasonably required. There are various kind of statutory burdens that HMRC has to go through in order to issue a formal information notice. But there are consequences of not replying to a formal information notice. daily penalties and large penalties. So it's important to make sure that if any clients have a formal information notice, that it is replied to or challenged within time. And the other thing to say in relation to HMRC's information gathering, sometimes when we get involved in an inquiry and somebody else has had, perhaps our client's accountant has been dealing with it so far. In the early days, quite often you just see questions from HMRC and responses from HMRC, and responses from the accountant. And the responses aren't necessarily talking to the risks that HMRC has uncovered. So it's always worth having a conversation with HMRC. If HMRC is asking for information, HMRC doesn't really know. HMRC will start from the point of view that we see a risk and we need to understand whether this is really a risk and whether there's really some tax to pay here. HMRC won't necessarily know what information is available within the business, so it will come up with a shopping list of things. If you have a conversation with an inspector, you may realise what it is they're trying to get at, and you may realize actually there's a different piece of information that can answer that question adequately. So rather than blindly providing, tens of answers to various questions which aren't really getting to the point, sometimes it's a good idea just to have that conversation. What is the possible problem? And is there something else that I can give you that's going to help you get an answer more quickly? I'm going to wrap up my piece now just to answer any questions if there are any, so everybody can get off and enjoy this beautiful sunny day.
Thank you very much, Jeremy. As you've rightly said, we have got questions been coming in throughout your session. Just before I get to those, if you could just humour me whilst I plug a couple of forthcoming CPD events that we've got coming up. So 19th of June, corporate tax. 3rd of July, how AI supercharges your finance team. We'll then take a short break over the summer and we'll be back on the 4th of September with accounting issues. So I think we've probably got time for one question that I've picked out particularly because it's a cracker. Can HMRC go after the director of a company for the company's tax debts? Sorry, the company's tax debt after it has been struck off?
Yes, potentially. Going back to the joint liability notice, that is a scenario where a director could be pursued for the debts of a struck off company. So in the case of it, there has to be several insolvencies though, typically. So in the case of a joint liability notice, if you've got two old companies, both of which have had an insolvency event and may well now be struck off, and you have a new company which is running a trade similar to the old company, HMRC can issue a joint liability notice which will make the director responsible for the debts of the old companies, assuming various other conditions are met. So that is one way, yes, they could come after you. Another way is if a penalty was issued, if a deliberate penalty was issued to the company before it was struck off, I think potentially the director could be issued with a personal liability notice. They would have to deal with that, but the company may still be struck off in the meantime.
Perfect. Thank you very much. As I said, I do have some more questions. I'm going to package those up and send them to you afterwards, if that's okay. I think that's about all we've got time for. We are drawing in on 10:30. In fact, we're there. Contact details for all of our speakers and myself are now on the screen. Feel free to connect either via email or via LinkedIn. You can particularly follow me if you want to keep up with everything that's going on at the K3 Hub on LinkedIn. Either connect with me directly. I share everything that K3 Hub publishes, or follow the K3 Hub page. That would be great. And that's about it for today. Thank you very much to everybody for joining us and for your engagement and all of your questions. And I think that's about it. So enjoy your weekends, and we'll see you back on the K3 Hub very soon. Thank you.